Hi, guys. Welcome to the 28th edition of the weekly trading wrap up, WTW, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As always, we start off with the market, the S&P 500 daily chart. This was a truncated week with Memorial Day on Monday, so we start off here. Big up candle Monday, Tuesday, Wednesday, Thursday. Excuse me, Tuesday, Wednesday, Thursday, Friday. Okay, there was Monday was off. So as you can see, after initial gap up, this was a pretty nothing week and a consolidation week to alleviate some, I guess, overbought conditions. Let's say, who knows. Is it overbought? Let's check the technicals. Nah, it's fair. It's hovering at highs. Okay. So like the reason why we gapped up on Monday was because on Friday we went down. This is Friday. We went down because Trump was angry at the EU and slapped, I don't know, 50% tariffs on them and 20% tariffs on Apple. But then on Monday, he says, I'm just kidding. I'm going to give them some time to talk. And that's why the market ripped and then stayed there for the whole week. So let's get started with the technical picture overall. Bullish still last week. Let's put on some moving averages here. Now the 200, last Friday it touched a key 575 level, which coincides with the 200-day moving average, which is the thick line in blue. And as you can see, during the panic, it never really tipped over. It went flat and then went, and now it's starting to go positive. Everything, all this bullishness for the past month has pushed up the 200-day moving average. So it's upward trending, from flat to upward trending. That's very positive, technically speaking. And we are technically above the 200. So this is a very bullish picture, okay? I was hoping we'd get a bit lower, maybe cover this gap here at 565, but it was not meant to be so far. So technically speaking, let's get rid of the averages. We don't need them anymore. So if you can just see a clean chart right now, technically speaking, we are in bullish territory, okay? However, we are coming into the summer doldrums, and usually the market stays choppy. And we will probably need a catalyst to move above the high. Something good has to happen, like really good for us to go above the highs. Could it be that, maybe inflation is abating? Maybe the Fed is going to probably lower rates? Who knows? We'll see. That's the only catalyst that I see going forward that might do this. But so far, technically speaking, still bullish. Okay. So let's go to the macro. The macro was pretty light this week, although we did have some key macro coming out. Specifically, everybody was waiting on NVDA earnings coming out, and of course the PCE that came out today on Friday. Okay, what happened with NVIDIA? Well, we'll get to that after. But first of all, let's talk about the macro that we generally talk about, which is what we look at every week. Are initial claims, and initial jobless claims were at 240,000. Okay, spiked higher, but still within our range. Again, nothing to worry about. As you can see, we're still within this area here. Again, the problems start and we start accelerating. Okay, and that hasn't happened yet. So the macro so far is still pretty good, although we have to keep an eye on it because it's spiking higher. And of course, the big one was PCE. Came in at 0.1%. They're expecting 0.1%, so it's nothing. This is the core PCE index. Okay, if this goes year over year, it's about 2.1%. Okay, let's see. Do they do the year over year? 2.5%, the core, but the normal PCE is about. Can we find it here? The PCE month over month. It's 1%, yeah, but let's see the PCE year over year. Yeah, that's at like 2.1%. Not the core, but the headline PCE index, 2.1%. The Fed is going to probably cut rates if it drops below 2%. This is a key thing. This is a big drop in PCE, okay, in the headline number. Starts going lower, below 2.1%, that will be the catalyst, I think, that rip the markets higher, because the Fed will have to lower rates there. Okay, everybody thinks that the Fed is behind the curve in lowering rates. They're keeping the rates high, well, because the economy is doing okay, as we saw with all the initial claims numbers and everything that we were looking at previously. So if we get the bullish catalyst is if inflation starts rolling over, maybe going to deflationary pressures, like a drop of 0.1%, a drop of 0.2% every month, then the Fed will probably lower rates. So that might be the catalyst, but that's going to be like in a month or two or three. Like it's not going to be right away. Okay, so that's why I think that we're probably going to stick around this range going forward, because the catalyst that I suspect will happen for the market to go higher is going to take time. You need like 2, 3, 4 prints of like PCE going down before the Fed is going to act, I think. So I can't think of another catalyst, but we'll see. But so far, for the next 1 to 3 months in the summertime, my outlook is like neutral. You should have some short exposure, because we're still, people are still bought a lot of calls, and this was the end of the month, so a lot of calls expired today. So we'll have to see, like a lot of Johnny-come-latelys here. So this is the market trying to work itself out. It doesn't know where it's going to go. It needs another catalyst to go higher, and anything disappoints slightly, it will drop. Okay, and I think it stays around this area going forward. That's my base case scenario. I don't think we revisit the lows, no way, because I don't think the big problem is tariffs. The big problem, as mentioned last week, is rates. The U.S. 10-year and the U.S. 20-year. Like the U.S. 10-year now is at 440. It's staying within this high range, and that's what's gonna like eventually kill the market. If rates stay this high for longer, the market will take a hit. Okay, it can't ignore it. So back to the macro picture. We talked about the NVDA earnings, okay, that came out on Wednesday after market, which was here, okay, this day. So but let's look at NVIDIA. What did it do? On Wednesday, it ripped up, on Thursday, because it was Wednesday after market. So this is the week. This is the 4 days of the week, okay? This is Thursday, this is Friday. So it ripped on Thursday because the earnings, if you can see, they were pretty good. They beat by 10% on the bottom line and pretty much flat to slight beat on the revenues, okay? So that was pretty good, okay? Any other time, if this was 2024, this stock would be up by, 20%. But it went up, finished up like 3%, which is like nothing. And then it gave up on Friday, gave up all its gains. So even though it had good earnings, NVIDIA going down is not a good sign, okay? And it went down because, Trump was talking very negatively about putting some kind of tax on China. So we'll see if that's true or not. That's why the market freaked out a little bit on Friday today. It came back to finish pretty flat. Okay, so NVIDIA earnings look like a good thing, but I think this is like a red flag. You should keep watch over that. When good earnings doesn't make this stock rip, and semis are a major driver of the market, you should take note of that. So that's one negative thing that we see. While the technical picture is still bullish, there are still some kind of cracks happening. One being NVIDIA, not reacting like it should in a hot market, giving up all gains. And the second is, what was the second? Oh yeah, the PCE we have to look at, but that's going to take longer. And the second thing is, it was a lot of people buying calls. Like the put-call ratio is still fairly low. So people are starting to jump on board bullishness, jump on board the call option train when the market is near highs. Okay, so you're having some, which is a contrarian indicator. You're having some like cracks under the hood. However, so far it's holding up. Okay, that's why I still have some short exposure going in, and I still have some longs, but I'm basically neutral. Okay, if the market goes down, I'll win on my puts, and if it goes up, the few longs that I have, because I got rid of a lot of my longs, will probably out earn the puts that I put in place and the spreads. I did various techniques to go short, to not go short, but have short exposure. Okay, I'm basically neutral. Okay, so that was the big macro coming out on this week. However, like one thing that should be mentioned was everybody was freaking out on Thursday that a Manhattan court ruled that Trump tariffs can be blocked. Okay, obviously that had absolutely no effect on the market, because the market finished, even though it's an indecision candle, it finished near the highs of the week. Okay, not the highs of the previous week, but relatively near highs. I mean, we're at 590, 589 specifically, because I bet you the 590 calls had to expire worthless today. So it finished slightly under 590, and the highs are like 613. So that's like, we're close to the highs. Okay, so if this market stays above the 200 for long, which it is, it looks like it's going to be very bullish. And I suspect that any down move will get quickly bought up, and we would stay around this range. So I don't see any big catalyst for a down move or any big catalyst for an up move either. Okay, so that concludes the macro section. So we had the technical picture, we had the macro fundamental picture, and now let's talk about, let's do an overview of the metals, okay? My favorite metal, gold, okay? Before that, let's just say that going into this, I had a couple of worries that the gold market would pretty much sell off during the summertime, because it is a historically weak period, seasonally speaking, for gold. But I am very impressed at how high it has stayed. It's almost at 3,300. Okay, while the market's at highs, you would think that as the market was going up, this will tank, like here. Like I thought it was going to go down maybe to 3,000 and hover around these areas before going up. But it's hovering literally 10% higher than where I thought it should be or would be going into a very hot market. And I'm telling you, if the market drops, this will go up. Okay, but it doesn't like gold doesn't have to do much. I mean, if it stays at 3,000, between 3,000 and 3,500, the miners are printing money. Okay, and eventually, like you can even see it on GDX, like it's staying at highs. Okay, it has a lot to go. I mean, it broke up this big pattern, and it's staying above that. It's consolidating above that breakout, which is very positive. Okay, this while the market is still going up at near highs. Okay, because gold is staying at highs. But let's see, it really needs to go to these highs right here, the 2011 highs of GDX at 66.76. Okay, these are the 2011 Halcyon highs. I still expected to get there, but over time. Okay, people have to believe. This sector has screwed a lot of people over in the past, but now it's completely different. The fundamentals have completely changed in this sector. So gold staying at highs is back to gold here. Gold staying at highs and consolidating at these levels. See, the RSI is basically flat. It has plenty of fuel to go either way. Okay, but because it's staying high, I think the next move was going to be up. Okay, but maybe not for the summertime. Okay, best case scenario for me is for gold to stay up here. Obviously, I'd like to go for it to break higher, but I'm saying realistically speaking, gold staying at these levels is extremely positive. You have no idea, especially how weak it gets in the summer. Okay. The other metal that we should be looking at is silver. Let's do a run through of the metals. Silver, still holding these levels, still consolidating at around the 3280 level, staying within its box here, staying within these highs when it should be doing nothing in the summertime. Okay, broke above the thing. It's almost like the same picture as GDX. It broke above an inverse head and shoulders and consolidating above this level while bringing its RSI to flat. Okay, it's almost the same picture for gold and silver. Okay, although gold is in much better position than silver. Silver would have to go above $50 It's at 32.87. You'd have to go about $50 to maybe 50, $60 to be equivalent to the gold move. But no, I'm still impressed. This is a sleeping giant waiting for the explosion. Not yet. Soon. Okay. And the other metal that we look at is copper. Copper futures, because that is Dr. Copper. It signifies the health of the market. And as you can see, it has that inverse head and shoulders pattern. Broke out like GDX and silver did, but it went back in. It hasn't like completely broken out above the $5 mark. Okay. Still consolidating at over 450 is amazing. Over $4 for copper is amazing. Okay, and for copper stocks. So copper staying at these levels when people are screaming that the markets are going to tank, we're getting a recession or whatever, is very positive. Okay, because this does not signify a recession to me. Okay, copper up and staying near highs, it's a good sign. Okay, so that is the rundown of the metals. You have gold, silver at gold, the alpha dog, silver, the beta dog, because it had broke out, and copper is the sea dog, or I don't know, zeta, who knows. But 1, 2, 3 in that order. That's how I would place them. Okay. Another interesting thing that happened this week was oil. Okay. As you know, still bearish. Fundamentals and technicals are bearish. We're getting saber rattling in the Middle East. Okay. Israel wants to strike Iran's nuclear facilities, and which is, I think it made oil move a bit, but I can't see it. This is it's still, the barrel is still at $60.68. Okay, broke below this key support level and still hovering below it. I mean, bulls can say it's hovering and then it'll go up, but to me this is still a downtrend with weak fundamentals. And OPEC came out and said that they're going to keep their current production schedule constant, which I guess it was a little bit of a disappointment to the market, because I guess they thought they were going to increase production. I guess, I don't know. I can't speculate as to why. But so far we have like still some saber rattling in the Middle East, geopolitical tensions, and nothing. Patience. I'm still short, holding. I added as it went up here more to what I sold like 30% on the spike of the news that OPEC is happy with lower oil prices and higher production. So you buy the rumor, sell the news, or in this case, I sell the rumor and buy the news. But then I bought back what I sold when it spiked up here. So now I have another full position, again, hoping that it goes down. Okay, just playing the odds of a terrible fundamental picture and a terrible technical picture. I fully expected maybe to go down to 50 and $40 a barrel. Okay, especially since we had the Memorial Day push, like everybody buys oil before Memorial Day because they think there's going to be like, people driving for Memorial Day, having like parties and going on vacation and stuff, but didn't do anything. None of that. None of the headlines are moving oil in any significant manner. So to me, still bearish. And the last thing that I wanted to mention is China. FXI, the Chinese large cap ETF. Okay, as you can see, it's a perennial loser. Well, not a perennial loser. It's a loser after triple top, down 61%, and then coming back and making about half to 40% of the losses back. Okay, it broke out above this key level, the FXI did, and it's still hovering above those levels. Okay, I like to look as my proxy for China. I like to look at Baba stock, Alibaba. It's coming within. It's the same picture, but not as good as the large cap ETF. And the reason why China is getting hit today and this week was because Trump started talking tough in China. Okay, he says they're going to impose some Chinese tech tax. Okay, that's always the danger here. Okay, that China and the U.S. get back into a trade war. By the way, the trade war is not over. Everybody thinks it's over. That's why the markets are highs. But no, there's just a lull. It's the eye of the storm. We don't know what's going to happen. Will it get resolved? Maybe. Who knows? But that's going to happen maybe in 2-3 months. So meanwhile, there's going to be tough talk back and forth. The picture hasn't changed. Okay, so even though we're heading to the summer doldrums, there's still going to be talk of tariff wars going forward. So I am still looking to enter BABA long again because I think China is going to start printing even more money. Okay, they're printing and they're going to keep printing. That might be bad for the Chinese person in terms of inflation, but who knows? They have to get rid of their deflationary pressures. So who knows where that coin will flip? That coin flip will fall. Will it be a positive for China, for the Chinese markets, or will it be a negative? Okay, will it be deflationary? Will the deflation outweigh the money printing? Who knows? We'll see. But I am looking to get back into BABA. Not yet. Okay? Not yet. We'll see. Okay. Things have to get a little bit more favorable. We might be getting close. Although I loathe to enter long positions in the summertime of, significant, like large size long positions in the summer. I might take a little stab at it. Who knows? But as of right now, I'm waiting and seeing. Okay, because China, 2 important pieces of news came out of China that I guess the market ignored. Okay, 2 things came out on Wednesday that we have to look at. Okay, one was that China announced plans to further open its commodities markets. Okay, they're going to let foreigners use FX as collateral for yuan trades. Okay, this is huge. This is another way of getting past the dollar as the world's reserve currency and where everything is priced, and everything meaning commodities, everything that countries and industry uses, commodities, are priced in US dollars. Well, now they're going to try. China are trying to get the yuan into that mix. They want foreigners to use their FX as collateral for yuan trades for commodities. This is huge. You're going to have euros for yuan. You're going to have francs for yuan. You're going to have rubles for yuan when making commodities trades. Okay, so that is a big deal. This is a huge step in the yuan becoming more of a global currency than it already is, because China protects its markets. And that's why foreigners don't really want to hold yuan, because you can't really transact in the Chinese bond market or in the Chinese capital markets as easily as you can in the EU or in the US or in Japan. Okay, so this is a step in China, on China's part, in them trying to get the yuan to be accepted more on the global stage. I think it's a big deal. Okay, and the second piece of news that came out on Wednesday is that Huawei, which is basically controlled by China, but let's say Huawei, pushes for the creation of a domestic chemical firm with a goal of cutting Western suppliers out of its supply chain. So instead of relying on companies like DuPont or Dow Chemical for their chemicals needs, they're going to create a domestic chemical firm in China. Okay, this is another big step, because the trade war, the whole goal of the trade war from the U.S.'s perspective is to onshore U.S. manufacturing back into the U.S., okay, because it's been gutted and shifted to China. And China, in response to that, must get its domestic industry to pick up the slack, because all it did in the past was just cheap manufacturing in China, dump it into the States. Cheap manufacturing in China, dump it in the States. The cheap manufacturing, or the manufacturing in China, wasn't benefiting the Chinese, the domestic Chinese, as much. Okay, and that's what it's doing now. It's trying to create a domestic Chinese market where the consumers, Chinese consumers, will pick up the slack that the U.S. consumers were pulling for decades, or for a decade and a half, since 2010, since let's say 2008, the great financial crisis. This is a chance for China to have its consumers get wealthier by creating its own manufacturing industry and letting the consumers buy their products. The Chinese consumers buying Chinese consumer products. They're already doing with electric vehicles, and now they're going to just further expand on that. So it's a big deal that they're trying to expand now in the chemicals industry rather than outsource it. So they're trying to do everything in-house. China is going to become a powerhouse in the decades to come. It's going to be a real contender to the U.S. It already is, might even be more. So this is the big battle now. So this trade war is really the beginning of the NWO, the New World Order, okay, where China and all other countries decouple. It's not going to happen overnight. It happens in small steps, but they're going to decouple from the U.S. and from the U.S. dollar. And it's happening. That's why you see the U.S. dollar going down, like, Dixie. Look at that. Broke the support, lower, going down from the highs of 110 in January to 99. That's a big drop for the world's reserve currency. Okay, so all these things are impacting. You have China decoupling. You have dollar dying. You have gold holding, because the real thing is gold being bought by foreign central banks, because everybody knows that there is no currency that could serve as the global reserve currency other than the US dollar for the reasons I mentioned before. The US is uniquely positioned to be the world's reserve currency, for various reasons: open markets, a well-functioning bond market, the willingness to be a net importer because it has to export its dollars if you're the world reserve currency. No other country could do that, even China. China needs to be an exporter now. It's going to try to become an importer later on. But now it's a net exporter. And the only competing currency that foreigners have that goes against the US dollar reserve currency is gold. That's why every other country is buying gold, because that is the only thing that could give them legitimacy when your opponent is the US and the US dollar reserve currency. So that's what I wanted to say about China. Still looking to make a trade, well, not on FXI, but I'm still looking to make a trade on BABA. I like China going forward long term. Haven't done anything on BABA. We'll talk about it when I do. But that's it for China. And that's it for this week. Still bullish. Let's recap. Bullish technicals, bullish fundamentals. This move might be getting a little bit exhausted. We're seeing some cracks under the hood. A lot of call buyers, rates still high. Maybe we have to correct a bit. But so far, still bullish. Looking forward to what's going to happen next week. Later, guys.